A very warm welcome to all our esteemed NRI customers joining us today from around the world for our monthly webinar series on Life Beyond Borders. My name is Deepa Thakkar and I manage the NRI products and portfolio for HSBC India. Today we will be discussing a topic which is of utmost concern to most of our NRI customers on remittances, repatriation and taxation for NRIs in India. We understand that navigating life as an NRI can come with its own set of challenges, particularly when it comes to financial matters like remittances, repatriation, or taxation. These aspects can often feel complex and ever changing. That's precisely why we at HSBC India are thrilled to have you join us today for this informative session. We are here to help you simplify and demystify these topics for you. Over the next hour, we will be joined by Surbhi Marwa, partner at EY India. Surbhi brings extensive experience and is a partner in tax practice. She has over 20 years of experience in the areas of family succession planning, employee taxation and advisory, exchange control issues, with a focus area on HNIs and family businesses. Today, Surbhi will guide us through the nuances of understanding NRI remittances and the latest regulations, simplifying the process of NRO account repatriation, demystifying NRI taxation, including what income is taxable and what exemptions you may be eligible for, and navigating the investment landscapes in India for NRIs, focusing on both listed and unlisted securities. So, without further ado, let's dive into the world of NRI finances. Please use the chat function below to submit your questions and we will address them during the session. Over to you, Surbhi.
Thank you so much, Deepa. Thank you. I think, I'm very interested in this topic, not only because I am a tax practitioner, but I also have two siblings who are NRIs, one in Australia and one in the US. And they keep finding while I file their returns, so they don't have to worry about much, but they keep finding it complex. But I must say that one thing that my sister was here from Sydney. She was, I think one thing that they're very impressed with is the technology in India. The amount of data that is being fed at the back end. And I always tell them that whether resident or non-resident or wherever, the taxman probably in India now, because of all of the technology, has more data about you in terms of your transactions than you. So therefore, it is all the more important to know what you have to do in India, what you have to file. A lot of questions around, how do I take my money out? I have an old property in India, inherited. I want to sell it. How can I take it out? And a lot of confusion also, because a lot of NRIs ask me, this $250,000 limit, how do we navigate? And I tell them, well, that is a limit for residents. That's not a limit for non-residents. And very often they are not even aware that there are two different limits. So yes, Deepa, this seems like we do a lot of, so Deepa and I do a lot of these series together, and it's like one of those coffee with Karan episodes. Of next kaun aayega. Unfortunately, we are the same guests every time, but we have different things to talk about. So I know you got a lot of questions as a precursor to this as well. So I'm hoping that I can answer as many as I can.
Sure, Surbi. Thank you. And you completely understand from home perspective also how the NRIs feel about taxation. And that's what happens with most of our NRI clients. So,
Right.
Surbi, I'll start with, we have a lot of outbound NRIs that we onboard in HSBC India. That means people moving because of their job changes overseas, or students, they go for their overseas education and then they settle down there. So, a basic question to start with is that when does a person become NRI? And when should their tax status be changed? And when should they start filing their taxes as NRIs?
Okay. So the Indian tax laws are quite complex. I don't want to get into the one case study of various different types of laws, but I will give you a general idea, and then and then sort of when the year progresses, it is also important to redo or relook at the status depending upon physical presence. So the first rule is that India, unlike the US, does not tax a person or does not make a person's residential status according to the person's passport or citizenship. Whether you are an Indian citizen or an overseas citizen or an OCI, unless there are some exceptions for UAE, but you are always categorized in terms of your residency status depending upon the physical number of days in India. It doesn't matter whether you came as a tourist or for a business or as a student, it's physical number of days. And every minute in the country in a day is a day. Now, let's assume I'm going outside the country for the first time. Now, if I am a person who is an Indian, then when I go out for the first time, and our fiscal year is April to March, I am allowed to spend up to 181 days in India in that year. And then when I go out in that year, since I'm going for the purpose of, say, employment, I am a non-resident. So I'm going to retrace. Normally, and the clear and easy rule is anybody less than 60 physical days in one fiscal year is a non-resident of India. So if you come for holidays, etc., so if you've spent less than 60 days, very clear non-resident of India. Exception is Dubai, UAE, I'll come to that. But there are exceptions to this rule, which says if you're going out for the purpose of employment, etc., and there are sub rules to that, then this 60 days becomes 182 days. So, first of all, important thing, why are you going? If you are going, can you exceed the 60 days? If you have to ask your tax practitioner about it. If you are less than 60 days in any fiscal year, you don't have to ask anybody. You're always going to be a non-resident. So this is the important thing when you're leaving India for the first time. Now let's come back to the question. You're outside India and you come to India for visits, etc., for meetings, visits, to see your family, to work in India for a few days. Now, again, the 60-day rule is sacrosanct. If you're less than 60 days, nothing to see, you're a non-resident. But if you're coming for a visit, again, you can extend this 60 days to 120 days or 182 days. You can extend it to 120 days if your income in India is less than 15 lakhs. You can extend it to 180 days, 82 days if it is, if the income is more than 15 lakhs, it's 120 days. If it's less than that, it's 182 days. So the important thing is, I've been outside Surabhi, I'm coming for a visit. If I'm less than 60 days, fine, Deepa, you're always a non-resident. If you're more than 60 days, you need to come to me. I need to see your Indian income and say, can I take a view that you've only come to India for a visit? Visit is not defined in the law. So can I give you the extension of 120 and 182 days to make you a non-resident? Complex, don't want to confuse, but like I said, less than 60 days, nothing to worry. More than 60 days, it depends upon your city that time for the purpose of extensions, depends upon your passport, and it can be 182 days. Coming back to India for a visit can be 120 or 182 days. The only exception is UAE because our laws changed a few years ago. In the UAE, and if you're an Indian citizen, and that's when citizenship also matters, you will always be a deemed resident of India. It doesn't mean that you are going to have have taxation of global income. You're going to be a deemed resident if your Indian income is more than 15 lakhs, which means that you can't in your income tax return write NRI. You still have to write resident, but the residency category is not of a full blown resident. It is still a residency category called not ordinary resident, where your global income does not need to be taxed. So just leaving these thoughts with you. If you are in UAE, please come back, but doesn't mean that you get frightened that, oh my God, I'm no longer an NRI. Do I have to tax my global income? So this is a general overview of residency from an income tax perspective. I know, Deepa, you have questions from a FEMA perspective also, but I just wanted to reiterate this is income tax because FEMA has also 182-day rule, but is a slightly different definition. Back to
Yeah,
you,
we
Deepa.
did meet a client also, Surbi, if you remember, who thought that because he doesn't have an Indian passport and he can come and he will always be considered as an NRI.
Yeah,
Yes.
classic example. We met that client, I think, in one of our events outside of Delhi. And the client said, I keep coming. I don't even know 150, 180, maybe 200. Sometimes I just feel like coming. But Surbi, I have a Spanish passport. So I'll never be a resident of India. I'm always going to be an NRI. So I said, Sir, Deepa, and I said, sir, we need to talk to you. You probably are a resident or a not ordinary resident of India for the last many years. So we really need to see, your tax affairs. So please don't be under that myth that if you've sort of given up your Indian citizenship and your an OCI, you can come and go as you please. You have to keep that day count into mind, in your
So,
mind.
Surbi, just a follow-up question to this, that many of our student customers, right, who have gone for a year, 2 years, they don't convert their status to non-resident many times. They keep it as a domestic account because they want to come back to India after
Correct.
their 2 years of education. So, what is the right approach that they should follow?
So conversion for the conversion of accounts, Deepa, again, you have to look at the FEMA or the exchange control residency and not the income tax residency. That's the first thing. But there are views, very clear positions that you can take to say that when they are going for a defined period or they're going outside of India to study. And again, the law or the FEMA law doesn't talk about going outside of India to study. It talks about for a permanent period or a non-permanent period or gives a few examples. But there is a view to take that if they are going outside of India and they have spent less than 182 days in the year preceding as well, then they become non-residents of India under exchange control law. In fact, there is one view to say I don't even need to see the year before. If you're going for the purpose of education, you don't know how long you'll stay.
Yeah.
It's uncertain when you're going to come back. Then also you can be a non-resident under exchange control laws, and therefore your savings bank account needs to be changed to a non-resident ordinary account. Most people, in fact, Deepa, want to change their accounts. And the reason they want to change is because what money you can send out from a resident account, which is the $250,000 subject to a TCS that we last talked about, the limit from an NRO account is 4 times that plus current income, and there is no TCS. So therefore, now I've seen that as people are becoming more educated, they're coming to us and to bankers and saying, I think my status as per exchange control is now non-resident. I need to convert my account, and therefore I can take more money outside India in a legal manner. And I know your next question will be, what are the limits? So I'll just wait for you to ask me that question.
Yes, exactly. That is the
Yeah.
next question. In fact, people are also asking us that which types of income earned in India are taxable for NRIs?
So the rule is any income sourced to India is taxable in India. Whether you have come to India at all for the last many years, whether you spend 0 days in India, if it's sourced to India, it's taxable. Now, what do you mean by sourced to India? And again, I'm not using the tax language of deemed to be received. I'm saying sourced to India, which also means received in India, but has an India connection. So I'm speaking in layman terms for everyone here. Rent, you have a property in India. If there's rent, it's an Indian sourced income, so it's taxable. If you have investments in India, you have shares, you have dividends, etc. from those, it's deemed sourced to India. If you have interest from your bank accounts in India, it's sourced to India. So anything which is received in India or sourced, as in the connection is in India, is taxable in India. A tip I'll give you is that if you have foreign income, but you bring that foreign income directly into India without first hitting a bank account outside, that is also then taxable in India. So, for example, if you sell your house overseas and you tell your banker, I want to get the money directly from Singapore to India, that becomes taxable. So, first, let it hit your Singapore bank account. And then, if you want to bring it after 10 years or 5 years or later, for the purpose, maybe you want to live in India, then it's already tax paid in Singapore. It was not taxable in India, so it's not taxed. So, in a nutshell, anything which where the situs is India will continue to be taxed in India, irrespective of whether you spend even one day in India or not. However, now another question, I think a leading question will be, sorry, Deepa, just wanted to add, supposing you are a US green card holder or a US citizen and an NRI of India, just like my brother, and you are therefore subject to global taxation in the US. Now you'll say, oh my God, 39% here, and 39% is the top tax rate in India under the new regime. Of course, capital gains, dividend, etc. for NRIs is different. But what if now I have to pay tax in the US also because, hey, you know what? I'm a green card holder. I will say, don't worry, the US should be giving you credit for all the taxes paid in India. Very often I'm asked, can I pay taxes only in the US? I don't want to pay tax in India. No. The Indian revenue system has the first right to tax because this is Indian sourced income. The credit is given by the country which has the second right to tax, because here the US is taxing you simply because you're a green card holder. There is not, the money has nothing to do with the US. So they will give you a tax credit. So supposing $100 is the income, if it's taxed at 20% in India, which is $20, and it's taxed at 30 in the US. So in the US, you'll pay only the extra 10 rupees, which is 30 minus the 20 you've already paid. And the US government or the US tax preparer, not the government, is going to ask you, give us details about showing the tax paid in India, for which we'll give them your 26AS, we'll give them your tax returns. And that is something that is a very known, very settled procedure. Credits are also very settled procedure in the US and in other countries as well.
Understood. Surbhi, there is, a follow-up question on your UAE explanation that you give. So many of our clients are asking that, can you please re-explain the UAE exception? Because most of them thought that if they are working in UAE, then they are non-resident in India. So if you could.
So a few years back, about I think 4 to 5 years back, the Indian government tweaked our tax rules a little bit, our residency rules a little bit, and they said that anybody who is a Indian passport holder and they go to a country where where they are not liable to tax. So the only countries, I guess, in the world today where there is no tax rate for personal tax are the Gulf countries. They will continue to be deemed residents of India. Now, there are certain income limits to this as well. So, what this means is that if you are going to work in Dubai, for example, I'll just take the example of Dubai, but you still hold your Indian passport, you have gone to work in Dubai, you will not, and suddenly you don't come to India at all, but maybe you spend 20 days or 25 days or whatever, you will still be a deemed resident of India, which means that you will not write the NRI status in your return. Your return will say not ordinary resident. So there is in India, there in under the residency categories, there are two categories, not ordinary resident and ordinary resident. I don't want to explain those to you too much because most of you are not residents here. But your return form will say not ordinary resident. Now, the fear here is, oh my God, am I resident? So is my Dubai income going to get taxable in India? I think that's what the question or the fear is. No. Let me first clarify. Your Dubai income will not get taxed in India because NOR is very similar to NR. The taxation norms are the same, that only your India sourced income gets taxable. Your overseas income doesn't get taxable and you don't have to report foreign assets. So the return form will say NOR. Now you'll ask me, "Phir kyun kiya? Why did this happen?" It happened because certain dividends, etc., the rates of certain dividends, etc., if you go under certain treaties, are lower for non-residents. And they are not low for not ordinary residents. So typically, if you are supposing a family business holder getting millions of dollars of dividend, earlier because of the treaty and because of your non-resident status, your dividends were taxed at a lower rate because that rate was allowed only for non-resident, and that lower rate is not allowed for not ordinary residents. So I think the play here is only for typically, and the play or the impact is only for those big amounts of dividends. For most people who are living there and they're working there, like you gave the example, don't need to worry. Your taxation or the amount you were paying tax on, unless you have massive inherited wealth or some dividends coming, nothing is changing with respect to the taxation or the reporting of income. If you are, of course, in doubt whether you are becoming a deemed resident, what your situation is, then you can write back to us and we can do a specific fact check. But it is very important that if you're just filing your return on your own and you've been in Dubai for many years and you just write non-resident and leave it, it's important for you to read up or talk to us and understand that there is a concept of a deemed resident. It may not change what tax you're paying, but your disclosures, etc., need to change. So that is the key point I'm leaving you with.
Understood. So be moving on to the remittance part of NRIs. What is the tax rule for them to send their income earned outside India to their NRE account in India? And if they want to invest here in India, say in real estate or on in direct stocks or mutual funds, etc. So what are the guidance for income earned outside India and then investing in India?
So, a couple of questions here in, I think, Deepa, in your question. Number one, if you are a non-resident of India, I'm assuming you are not working in India because, typically if you start working in India in a year or so, you'll become a resident. So, I assume that your question is with respect to people who are sitting outside India
Yes.
or have gone outside of India and are earning money overseas. Now, bringing money into India is not a problem. We welcome foreign investment. So you can bring money into India, put it into your NRE account. The NRE account, as Deepa can talk to you further about, is funded from your foreign currency. Okay. The beauty of the NRE account is that till you are a FEMA, now again, I'm saying a non-resident as per exchange control laws, till you are that, and if you're sitting outside of India, not working here, you've left India for for a certain period of uncertain or certain period of time or several reasons, you are obviously going to continue to be a non-resident as per FEMA. So let's go with that assumption. I'm a non-resident as per FEMA. I have sent money from outside of India to my NRE account. Maybe I have parents here, maybe I want to invest, etc. One, you can send it, no problem at all. It's a NRE account, is a foreign currency funded account. And the other beauty is, till you are a non-resident as per FEMA, your interest that you earn on the NRE account is exempt from tax. So lots of NRIs want to send money through to the NRE account, and they enjoy the tax benefit. I'll tell you the catch. I had a client. He was always an expat outside, had lots of money in the NRE and was not offering it for tax, and obviously right thing to do. Now he suddenly comes to work in India for 2 years and he becomes a resident as per FEMA in year one itself, because one of the rules is when you come to work in India, you become a resident as per FEMA in year one itself. Now every year, he continues the same treatment of not offering the NRE interest to tax. So when we came in and started making the return, we said, no, sir, when you were outside and a non-resident, the NRE interest was exempt. But the minute you become a resident as per FEMA, the NRE interest becomes taxable. I'm letting you guys know because a lot of people are coming back to India. Their children are coming back. They want to work in India and they forget that their status changes. And with the status, some tax benefits change. So that is the taxation of the NRE. If people are bringing just money inside India, which is tax paid, which was earned when they were not a resident of India, bringing the money back into India does not make it just taxable, okay? Because you're just bringing it through normal banking channels, so that's nothing to worry about. And in India, as a non-resident, you can invest in pretty much everything. The only thing is that as a FEMA non-resident, you can't buy agricultural land. So that is the only other thing. Otherwise, you can invest in property. Most of our high-end luxury real estate is with non-residents also. You can invest in pretty much all the securities, and Deepa, I'm sure you can guide them on how to do it through your banking channels. The only other thing is whether you can do PPF, which is the Public Provident Fund, because a few notifications had come in a few years back that non-residents cannot open or invest into the Public Provident Fund. And there was just one notification, so the house is divided on that. But pretty much you can do everything except the agricultural land, which you can't. And PPF, it evolves. So if anybody's really keen to do it, we can, investigate it further and let you know.
Sure. Surbhi, now the reverse of what the earlier question was on now the income earned in India, because many of our NRI clients, they do have properties here, investments here, and they do keep earning returns or rental from these investments. So, how much can they send in a particular year? What are the FEMA guidelines on these remittances?
Okay, two things I'll tell you. And again, it's very, very complex, but if they're working in India, for example, we have lots of MDs and CEOs of Indian origin who are NRIs, but overseas citizens who are, or OCIs, they are OCIs who are working in India. There, one of the views is under FEMA that they can, whatever is their salary, they can, repatriate it outside of India. But I don't think the question is so much about people working in India. There'll be a few here or there, and they are anyway getting salary in India. So therefore, they, from a salary to salary account, there are certain exceptions they can have. I think your question more is about, people who live outside of India, they are non-residents, and they want to send, they have income from India because they have rentals, etc. And they now want to take it back to where they live because that's where they are living. Now, for a non-resident, from your NRO account, you can take up to 1 million US dollars plus current income every year. It's not the $250,000 limit. The LRS limit of 250 does not apply to non-residents. So that is the reason why most people, like in my first question, say, oh, let my child become an NRO, because if he has enough money in his bank account, which I've given to him, like I've built his corpus in the past, he can take $1 million plus current income. Now you'll ask me, what is this current income, Surabhi? And is there no limit to it? Current income is passive income. So supposing I have 1 million, I have $1 million in my bank account plus a few 100,000. That 1 million I can take, and that few 100,000 is interest that I'm earning on passive securities. Actually, as per the law, you can take the 1 million plus the current income, which is the passive income of few $1,000, which is the interest. You can take that also. Now, right now, there is no limit on this passive income. It's maybe it's a, maybe after this webinar, or maybe or maybe, one day it is plucked, because there's a lot of back and forth, a lot of questions that we are asking by how come the 1 million is sacrosanct, but the current income has no limit. But right now, the current income doesn't have limit. So they can take up to $1 million plus current income. Current income is passive income every year, every fiscal year. And all they need to do is they need to do a Form 15 CA CB, which is basically their CAs do. And from other normal banking channels, whatever paperwork, I think Deepa, the banks ask for Form A2s, etc. That, I mean, you would know that best, but they can easily take it out through banking channels. They just have to ensure that if the money was sourced from India, whether taxes were paid. So, for example, if you accumulated this 1 million out of all of the rental and the property, and you sold a property, then obviously you have to evidence that the capital gains were capital gains, and you paid taxes on these, etc. So that's really what the limit and how you take it out.
Yeah. Yeah, the current account one, many of our NRIs would not know. So that is really helpful, Surbi. But the next question is on NRE to NRO. Can I transfer money from my NRE to NRO account and vice versa? Can NRO to NRE, you explain $1 million, up to that you can send every year. What about NRE to NRO?
So NRO to outside of India, you can send $1 million plus current income. So I just want to re-clarify that. See, an NRE to NRO, again, a very banking question. My understanding, Deepa, and I'll ask you to also add to it, the NRE account is funded from Forex, foreign currency. But once the money is in India, you can use it for any reason. You can buy, you can, you can spend out of it, you can do UPI out of it, etc. So my understanding is that that money can go within the limit of the 1 million, because you are basically transferring it from your foreign currency account to the non-resident ordinary account. Now, several banks may be taking different positions, and so it's very important to be very clear from a banking perspective what is the position, and whether you guys as HSBC, because you have all your customers here, whether you would allow this transfer to happen. So my understanding is there should not be any issue with it. But I mean, from a banking perspective, would you also like to add whether this is something that the bank allows and what is the paperwork?
Yes, of course. So NRE to NRO transfers we don't allow. NRO to NRE transfers basis the due taxes filed above the limit that is permissible is allowed. And of course, our HSBC RMs are very well trained. So if our clients have any issues, you can reach out to us and we'll be more than happy to guide you. So the next question is on the NRE. You said in your earlier answer that you can keep the funds in NRE till you're a non-resident. Once you become a resident Indian, you need to convert that money and pay the taxes that are.
No. So Deepa, two things to it. The
Yeah.
money in the NRE account is funded from Forex. So you
Yes.
can keep the NRE account. It's
Till
only
how
that
long is what the customers are asking. Till how long?
I I don't think there are any limits to, whether you can, how
Okay.
long or how quickly you change it, because typically the bankers, the minute it is your care of duty to tell the bankers that I have become a resident of India. Now, I'll tell you some of these confusions that happen. And I'll coming back to the last question also, NRE to NRO. Uh, it's a forex account to a rupee account, and a forex account is funded. So can you transfer? One view is it in the $1 million? But like I said, it is the banker's KYC. HSBC says NRO to NRE yes, NRE to NRO no. So that is something you need to check with your bankers. Now the second thing is, I am a NRE holder and an NRO account holder, but I come back and start working in India. Now it is my duty of care to tell my bankers that I am no longer an NRI. I have taken up an employment with, say, Ernst and Young in India now, and I have become a resident. And my advisors tell me I have become a resident as per FEMA. Or I know please tell me, have I become a resident as per FEMA? Because now I am on employment in India, and here's my employment letter. So Deepa, you will come and ask me, Surbi, is he or she becoming a resident? And I'll say, yes, Deepa, since he or she has an employment in India, they've become a resident. Now, the bank's norms, and again, this is something I'll ask you to add, the bank's norms will therefore say that since you're no longer a non-resident, the accounts need to be converted. Or the norms may say that whatever you have held in the past before becoming a resident, you can continue to keep that. So there is a bit of a dichotomy. So maybe we would like to tell customers here, whether from a banking perspective, when they come and tell you that I've become a resident, or you and I talk and they've become a resident, what is the cutoff that you give them?
Yeah, so absolutely. So just to clarify to all the clients, NRE account cannot be funded by anything but only
Okay.
your income earned outside India. Any income that you're earning in India, even if it's in your NRO account, you cannot transfer it to NRE. You can transfer it to your resident account outside India. If suppose you're staying in say UK, you
Correct.
can transfer it to your UK account. But NRE account is, a regulated account, and only foreign income can be credited into that account. So the next question is on, double taxation. Many of our clients are staying in countries where, there is a tax treaty between Indian government and that government. So can you enlighten them? I understand that, country to country it may differ, but what should they keep in their mind?
So I'll give you a general rule, and
Yeah.
like I said, country to country will differ. Now, let's assume you're still non-residents of India. You haven't come and become residents, so you haven't come to work in India. You're still all non-residents. Your question on the treaty will only come via the income that you're earning in India. And I'll tell you why. Because as a non-resident, anyway, India is not taxing you on your global income. So let's take an example of the US. You are a US green card holder and a non-resident Indian in India. You have lots of income in the US, your interest, your dividend, your salary, plus you have rental, interest, etc. in India. Now, if you're a non-resident, first of all, India is only going to tax you on the India rental and the India interest. India has nothing to do with your global income. India is not going to ask you to report any of your foreign assets in your Indian return. Now, and India will by right tax that rental and by right tax that interest, which you have to pay tax on. And the government will have information about it from the back end, because anybody who's paying you rent also has to do a TDS, etc. The banks have to do an interest. Now, so India has to tax you. Your question is, I'm also probably going to pay a tax in the US because I'm a US green card holder. Now, like I had explained in the past, the double taxation is avoided by way of the treaty. Sometimes if you don't have a treaty, also there are norms to avoid double taxation, but pretty much I think most people from what we know are from countries where there's a treaty. So your US provider will ask you, have you filed a return in any other country, or do you have income in any other country? You'll say yes. Then they'll say, okay, what's the income and tax? Give us proof. So then you will give them the form 26AS. The form 26AS gives, and the AIS and the TIS forms give all the income. You may not have filed your tax return by then, because US has a calendar year, India has a fiscal year. So they will, so our return is filed much later. That is the reason most people will ask you for a form, or you will give a form 26AS, and therefore they will take a tax credit for all the taxes that you have paid in India, depending on the tax rate on the India sourced income. So this is the procedure that you will follow. I'm going to give you one very important tip, especially a lot of you are in the US or from calendar year countries. In the US, if you pay any taxes, so you have a year of Jan to December, but in India, you have a fiscal year. So our advance tax months are, are basically September, December. The first installment is June, September, December, and March. So very often we say, okay, I've earned the income in December, but I can stagger and pay according to the percentages. If you have a lot of income in India and you want to take credit of it in the US, prepay your taxes to December. Because if you pay the same tax in January, the US will say, sorry, sir, I'll give you the credit next year now in your next year's return. And you will be like in a working capital issue. So a lot of our clients, if they have a large amount of gain, etc. in India, and they also, we know that the US is going to tax it, we actually tell them, if your funds allow it, prepay, don't wait till March to pay the advance tax, pay it in December, before December 31, so that your US provider can take a credit at this without waiting for another year. I hope I was clear in that, because this is a massive amount of working capital flow. You don't lose the money. You'll get the credit one year or the other. But this way, otherwise you will have to first pay tax in the US, pay the whole thing in India, and then get a refund or a carry forward credit. So I think that is the other tip I can give everyone on the credit side. And I hope this
Uh,
was clear, Deepa, because it's a very complex
Absolutely.
thing.
No, absolutely. But yes, it depends from country to country. So, yes, they should definitely reach out to their tax consultant before taking any decision. So, many of our NRI clients, they do receive inheritance from their parents in India, be it from property or shares, mutual funds, etc. So, what is the liability of taxation if they sell the property here in India and it's an inheritance income? So, what is the guidance for that?
So if you inherit, like supposing you
Yes.
inherit by will, so just the inheritance doesn't give you, doesn't make it taxable. Of course, when you inherit and you transfer the property in your name, then you have to see all the stamp duty and other things. Those are depending upon the city in which you live, etc. Now let's assume I inherited something and after 5 years I've sold it. They will be, so you will do just like any other Indian, you will have to see whether there is a capital gain. You will see how much you sold it for. You will see the cost of acquisition. Be very careful here, because here the rules had changed a few years ago. What is the amount you take for the cost of acquisition? Is it the inherited value? Is it the 1981 fair value? Then you index that value for the cost of living. So after you take the base, it's not that you don't take the base as the actual base. You are allowed in India, which is a very, very good law. You're allowed to index it. So you use the cost of living index, and your cost price effectively goes up depending upon inflation. Then you do a sale price minus the expenses minus the cost. Cost, like I said, we have to determine what cost to take. And then you work out the capital gain or the capital loss. let's assume you don't want to reinvest the money. A lot of people say, okay, there are certain sections in India called rollover sections where you can actually reinvest capital gains up to 10 crores and get it and this is effective tax planning. Let's assume you don't want to take that tax planning. You can, and you've paid the capital gain. Then that money, once you've paid the capital gain, it goes into your NRO account. And from the NRO account, the 1 million plus the current income goes out. So the key point or the moral of this story is inheritance doesn't make it taxable. Once you inherit, the cost of acquisition can be adjusted. There are certain norms, the rate that which the previous owner bought it, or the 1981 rate. I again don't want to confuse people into something, but I'm just saying that the rules need to be seen. You can't just take the straight value. And therefore, once and you sell it, very important that you pay the taxes or you show that why it was not taxable, etc. And only then you can send the money out. Another tip, ladies and gentlemen, for non-residents, the TDS on sale, like for a resident, when you sell a property, the TDS on sale is at a very low rate. So the buyer, when they buy it from you, they will do a TDS so that the information that you've sold something goes into the government website. And if you don't file the capital gains, somebody will send you a notice. For non-residents, the amount is deducted at a very high rate. So a lot of non-residents come to us and say, I am to actually selling it at a loss, but the buyer has deducted full tax on the sale value of the property. So there we go and help them and say, maybe we will help you to get a lower tax deduction certificate, or sorry, you live with the refund. So all of you that who have a large amount of assets or property to sell, please, please understand you have to compute the gains first. Please understand that there is a tax deduction that will be done. It will be at a higher rate versus your friend who's always lived in India. And you may want to go to your tax provider and say, is there a way that I can get a lower tax deduction certificate, or should I live with the refund? So just giving you that whole idea also, so that you know that, because once you sell it, once the buyer does all the taxes, the deductions, then you only have a refund to live with. So this just giving you this a little bit of tip, which is what I promised Deepa, that it's not only, as they say, gyan that we want to give you. It's very, very complex gyan. I hope everybody's understanding and nobody wants to shoot me after this on a Friday. But the point also is to give you tips so that you remember that Surabhi and Deepa had talked about some TDS, they had talked about some 1 million in current income, they had talked about some funds, how they can flow from NRE to NRO, how to convert. And then we go back to them and say, okay, now tell me what the rule or the law is. So that's really the purpose.
Yeah, no, it's absolutely clear, Surbi, and thank you for your tips. I'm sure it's helping our clients. Surbi, the next question is, many of our NRI clients, they want to invest into, unlisted companies here in India, like startups, because, India is, grooming, and, we have one more unicorn got announced today, right? So many
Right.
of our NRI clients, they want to do investments here into unlisted companies. What should they keep in mind on the taxation part of it? The returns, if they invest and after say 2 years, 3 years, they sell their shares, what should they keep in their mind in that?
So, one, can you invest into unlisted securities? Typically, either you invest straight into the founders fund or you do it through an AIF. So there'll be a category. Typically, you will do a category 2 or 3 AIF. A lot of my clients who have left the country, what I have suggested to them is that they speak to the founders, and they also speak to the AIF, the people running the AIF, to check whether the money still needs to come from a resident account or whether any call money can come from the NRO account. Now, typically in an AIF, you would have put the money right at the start. Sometimes it's staggered. Sometimes you want to put the money. Again, there are no FEMA restrictions which say that the money has to come from a resident account. So nothing to worry about, but that information should still be very importantly given. For unlisted equities, etc. And in India, we have a very complex capital gain regime. They are short term, long term. Debt is taxed at a different rate. Equity is taxed at a different rate. So you have, and the period of holding is different. So in certain cases, it becomes long term at after 12 months, in certain cases at 24, in certain cases at 36. So it is, by the way, every year I write lots of articles on please simplify the capital gains taxation regime. So that is something that, we hope that will happen once the new government comes in. But there are rates at which unlisted shares and securities get taxed. For example, unlisted, um, if it's a short term gain, it's at the slab rate, whatever rates are prevalent to you. If it's long term, it's 10%, and the long term is 1 year or more. If it's maybe debt oriented mutual funds, again it's slab rate, but you have to hold it for 3 years to make it long term instead of 1 year. But then the taxation, after it's long term, it becomes a lower amount. So can you invest? Yes. What is the tax treatment depends upon debt, equity, etc., and whether indexation is taken, not taken. But you know what, I'll also tell you, our tax system is brilliant. Most of it is, you can download your tax return forms, and a lot of data is fed in, so ITR 2 3 etc. And when you feed in the information, one, they pick it up. The return forms also have the ability to, once you put in the data, to calculate the tax also. So while it is important to have your provider give you the advice, but you will also be able to, whoever is helping you, or if you're trying to file on your own, and I'm putting an axe on my own foot by telling you this, but sometimes it is also, you can get that information from the income tax website. There are calculators, and we have helped. So TOI has a calculator, for instance. Ammu, my colleague Ammu, and others are, have actually, Ammu, they have actually, helped them also to do the calculator. So use all of those things to calculate your taxes also.
Thanks, Urbi. Next question is, many of us come in India, they only have their NRE account, which of course, is the foreign income. They do some investments here through the NRE account. And NRE income on NRE is tax free, but still they keep getting reminders from tax authorities in India to file their taxes. So the question is that, do NR customers who only have NRE, do they have to file taxes in India even if it's no income that they have to file here?
So if you have no income in India, or your income is less than the taxable limit, you don't have to file tax returns in India. There are certain rules as to certain expenses that you incur. For example, I'll just tell you, if you've deposited an amount of 1 crore or more in your current account, if you have incurred an expenditure of 2 lakhs or more on some foreign travel, etc., some of these norms happen, but typically you don't have to file a return till your taxable income exceeds the amount which is not taxable in India. Why you're probably getting a reminder could also be that you have listed on the tax base. So supposing you've been filing returns for many years, or either because you lived in India and now moved, or at that time because you had some income in India, or you had a house you sold, or you used to get rent, which you don't anymore because you've taken the money outside, you are already registered into the income tax base. So, and it's very techno driven. So therefore, you will get a reminder for advance tax. You will get a reminder to file your return. So, and it's automated. I get it. For instance, if if I haven't paid my advance tax because I feel, okay, I have no advance tax payable this quarter. It never happens though. But I will get a reminder because it's all automated. So it is not because the government wants you to pay tax on your NRE interest. It is also because you may be in the database for this reason. So I'm just taking I'm just saying this by experience. Or you could have some transactions, the government also picks up. There is that, not the government, the tax department also has intelligence through a AIS and TIS, where they pick up investments in mutual funds, they pick up these expenses, and one of these reasons could be why you need to also file returns. So look at the whole picture. I mean, if you're totally disjoint from India, there's nothing, no income, no transactions, no money in, no money out, then it is only, like I said, could be because you have a earlier history of filing.
So many of our clients are mariners, the seafarer. They do work for companies which pay them in foreign currency, and the companies are based out of outside India, and they are NRIs. Anything that they should keep in mind when they are filing
So
their taxes?
they are separate rules, again, for people on ships, on aircrafts. There are separate rules for taxation. There are separate rules for residency. Anyone here who had this question, I would please request you to reach out to me and Amu, because we will like to first understand your question and do a fact specific exercise. To your point, am I the same as a not a college professor? Am I the same as the CEO of a Indian company, and are there different rules for me because I'm on a ship or an aircraft, or if I'm just stopping over in the country? Yes, the residency rules for you are different. They are quite complex rules, and it depends upon what waters you are in, etc. So it would not be fair to give you a general answer. I may not know your situation, and therefore I don't want to misguide you. So please do write into us through HSBC, and we will look at your fact specific issue and respond to you, because there are definitely different sets of residency and other rules.
Yeah, thanks for that clarity, Surbhi. The next question is on, some documents. So, when there is an NRO repatriation, Form 60 of CA 12, and we require to have these documents plus a CA certificate also. So,
Correct.
clients are asking, what is your view? Is a CA certificate mandatory for doing a NRO repatriation?
So I will tell you this. Typically, yes, it is important, but a lot of it depends upon what the banks ask you. See, the bankers, and I have a banker here with me, are the gatekeepers to the RBI. They are supposed to maintain all the documentation standards. So I may have whatever point of view, which is a theoretical point of view, but since you're all HSBC customers, very simply, if HSBC wants this CA certificate and they are not going to effect the transfer, which I think is the case, Deepa, then the
Yes.
CA certificate is required, because that is the systems that they have put in place based on the guidance by the RBI. And very often that guidance may have two views, but as an international bank, they may be taking a certain view. To my understanding, the CA certificate is required. The tax return, the form A2 is required. Evidence of tax paid is required, because these are just their gatekeeping norms. Deepa, if you want to add anything to this.
Yeah, absolutely. So these documents are required, and we are following the FEMA guidelines. So, while you may have read in some article that it is not mandatory, etc., but these are mandatory, and we would request you to please follow these rules. And coming to the next question, Surbi, is on dividend income. How is
Sure.
the dividend income earned by NRI from Indian stocks taxed? Do we pay tax on it? Amount of money days as well is
Sure.
on Aadhaar and PAN linking. Many NRIs, they do not have Aadhaar, but they keep getting reminders from Indian authorities to link their PAN to their Aadhaar. So what is, from the CA point of view, what is the rule exactly?
So the Aadhaar number, and there are going to be some changes for Aadhaar for non-residents. It was in the news as well. The Aadhaar is not required by non-residents under certain rules. From what I remember, it is if you have not been living in India, if you have not spent 182 days in India. But I can check that, and maybe Deepa, we can send it to all of your customers also. When does a non-resident need an Aadhaar? But typically, these are these rules. So anybody who's never visited India for 10 years does not technically need an Aadhaar. Again, a few tips that I'll give you. You may not need an Aadhaar, but if you have property etc. in India, it is recommended that you get it, because Aadhaar is becoming a social security number. And when you sell etc., I have seen practically that they do ask for the Aadhaar and other numbers. And if you have an Aadhaar card, even if you're a non-resident, linking the PAN to the Aadhaar is a 1 minute job. So one is the theoretical part, and like I said, we are not here, Deepa and I, just to give you gyan. If you are able to get the Aadhaar made, if you're coming to India and you're able to get it made, there's no harm in getting it made. You don't get into any specific system. It only makes life easier for you later. Technically, you may not, however, require it, and we can send you those details as well. But if you have a lot of assets, etc. in India, it is preferable to get it, because like I said, if you're selling and all, later they may ask you. And therefore, if you have the Aadhaar, do link it with your PAN. It is the it is from a practical perspective also, and also to avoid the reminders, is the right thing to do. It is not a cumbersome process at all.
Yeah, that really helps, Surbi. The next question is that, what tax should they file? What returns they should file for their NRO account or whatever income they're earning in India, the income that they declare in India, what tax document they should file?
So the ITR forms, we have several ITR forms. We have the Sahaj, we have the ITR 2, we have the ITR 3, and every year certain tweaks are made, or some not new forms don't come every year, but the sometimes the forms are also changed. We used to have Saral, Sahaj, etc., and the various forms are changed. So look at the form that applies to you. If I remember correctly, it should be the ITR 2 or the ITR 3, depending upon whether you have income from business or profession, etc. So if no business income from business or profession, then ITR 2. If income from business or profession, then ITR 3. But like I said, every year this needs to be checked, and it's very easy. Go to the income tax website, they'll tell you this source of income, this, and that's something we can, Deepa, Amo can send that to you, which you can send it to your customers as well. So that's not a problem. So look at the ITR form that is relevant to you. I've already told you which are the typically relevant forms, but if things change, we will give you that guidance. And then just file the taxes in that form, and you're done. Like I said, for my sister, my brother doesn't have any interest or any income in India, so I don't need to file for him. My sister has an NRO account. The bank does TDS. It's a smaller amount, but so I filed the return for her. I say income taxable, total income this much. That the taxable income becomes zero, because the interest is not above the taxable limit in India, and therefore tax payable zero, tax deducted at source X. So the X comes back as a refund. She has an NRO account in India, and it gets credited back into her account. And also the form, when I'm filling out a return, the 26AS amount and the TDS certificate she gets from the bank, and she's also with HSBC, Deepa, also tally. So immediately it's all populated at the back end as well. So it's not a very cumbersome task, but do file your returns, because see, what happens is, if you don't file them because you say, oh Surbi, I didn't file because I get a dividend income or interest of 50,000, I know it's not taxable in India, or I get it for 1.5 lakhs. Now it's not taxable, I agree, but the bank has done TDS, and if you don't file, the government sees a TDS under your PAN number, but no tax return filed. So then you will get a notice, and for no reason you forego your refund and you get a notice. So that's why we tell people it's an easy job, do it, and avoid getting notices, which people do feel scared of or uncomfortable. You don't want the taxman knocking on your door. You only want
Understood.
tax consultants knocking on your door.
Understood. I think there are some comments on, transfer between NRE to NRO. So just want to clarify if there is, some misunderstanding that you can transfer money from NRE account to NRO. NRO to NRE is not allowed because NRE can be only funded from your foreign income.
Correct.
Because I don't want our clients to get confused. I'm just clarifying it once again. Uh, so the last one, mariners, you said that while they are considered NRIs, and if they have any questions, they can reach out to us. Just wanted to tell all our clients that HSBC, in its Beyond Banking Services, has partnered with EY as a tax partner. And if any of you have any queries, all our premier clients get 1 hour of complimentary consultation session with EY, and you can connect with them, understand your India taxation, if you have any doubts, etc. And then EY team can take it ahead from there. So please do not hesitate if you are interested in having, because many of our clients are asking for connecting with Surbi. So if you have any personal questions, because everyone's circumstances are very different, they are from different countries. So if you have any questions, you can reach out to your relationship manager in India. They will help you connect with Surbi and her team, who will guide you with them. So a lot of our clients are UK customers, right? Is there any tax treaty, or if you can just take last 1 minute on US India, UK India, what are the taxation between these two countries?
So similar to the US, but UK is a little less complex because our fiscal year and their fiscal year more or less is the same. They have, I think, they also have April to March. I think 7th April or 5th April to 5th April starting. So very close to our fiscal year. So it's very easy to then take credits, etc. Same situation. The the India income is taxable in India, and UK will give a tax credit. So nothing changes vis-a-vis the question that I gave in the US. You don't have to also worry about the calendar year and the fiscal year dichotomy issue in the UK. So it becomes a lot simpler. Also in the UK, when you're any advice that I'll give you for UK also is just speak to your UK providers, because there are there is a change in the way UK, I think the budget was presented, and the domiciliary rules in the UK are undergoing or have undergone a change in terms of how the domicile rules change and how you're taxed. Deepa, it's also a text also that I sent you, so if you want to just maybe circulate that with all your customers, I think it's very relevant from a UK perspective. But otherwise, there is a tax treaty with the UK, and the same answer I gave for the US is helpful. But the complication of calendar year versus fiscal year, and therefore preponing the taxes, that doesn't happen here because we are the same. And just to end, Deepa, I hope everyone is clear on the NRE to NRO. I think from a banking
Yes.
perspective, I know what you guys allow, so we want to be very sure that when they're doing the transfers, the bankers allow it.
Yes, yes. So the question on NRE, NRO, because it is complicated. So I just thought that, I'll clarify that, NRE is a foreign income. So,
Correct.
Anything deposited in that needs, your tax advisory, tax consultant's advisory. But from NR, so, I hope we are clear on this. And if you have any further questions, please reach out to
Please
me,
go
and
ahead.
me, your relationship manager. We would be more than happy to. There are a lot of questions that, can we have future reference to this session? Yes, the YouTube handle of HSBC India will have this session and all our previous Beyond Banking sessions also available. You can refer to that whenever you want. Thank you, Surbi, for that insightful session. We truly appreciate your time and expertise. Thank you all our esteemed NRI customers for joining us today. We hope this session has been helpful in navigating your financial beyond your borders. For any further questions, please don't hesitate to reach out to HSBC India, your Premier Relationship Manager. And thank you and have a wonderful day.
Thank you.